Hello and welcome to this weekly market recap for the week ending Wednesday, April 9th, 2025. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and it's a pleasure to be back with you all again this week. I do apologize for missing last week. Had a family medical issue, so I had to take a trip, but I'm back, ready to go now. And again, like I said, very happy to be back with everybody. Of course, while I was gone and this past week, the stock market's been absolutely insane. We've seen incredible volatility. We saw the VIX spike up to 60. Normally, when we see that, it's just a matter of when we're going to get that rubber band snapping back. And we got that today, a little bit after noon, Eastern Standard Time. That's when President Trump came out, announced that there would be a 90-day pause in tariffs for most countries, China excluded. So we still do have issues with trade in China, so we'll have to keep an eye on that, see how that all plays out. I don't think this is over just yet, but for a lot of the uncertainty, we did kind of kick the can down the road for 90 days, and the market expected about the way you would think it would. We had a big sell-off leading up to this. Remember, we had fallen about 700 points in the S&P 500 since the beginning of April or late March. So this huge rally that we had, yeah, I mean, it was great, but it essentially got us back to, almost to where we were a week ago. It really, on a net basis hasn't done a whole lot. And I'll show you on the chart here in just a minute, what we're facing on the S&P 500. But let's not forget, tomorrow morning we have the CPI report out for the month of March. What if that comes in hotter than expected? We've already got the Fed not quite sure what to do. And if, now if we get a hotter than expected inflation report, the Fed could be, thinking that this pause in interest rates is going to be longer than previously anticipated. So there's still a lot that we've got to deal with in the market. Today felt great. I don't want to be the downer here, but this isn't over. Short term, we got the nice rebound. I think that we still have some issues that we're going to have to go over and deal with over the next few months. So I think this period of uncertainty likely continues, but there's some key levels to watch where I think it could start to give us a different signal. But for now, I'd still remain somewhat cautious. Let's take a look at what happened in the market over the course of the last week. So remember, this is Wednesday to Wednesday. So Thursday morning through Wednesday. So it's not exactly the kind of week, normally we're looking at the calendar week. That's not exactly what we're doing here. But I just want to make sure that we're clear on the period that we're covering. So since last Wednesday's close through today's close, the Dow Jones Industrial Average, you can see down 3.83%. Actually, let me sort this for you. Performance. NASDAQ was the best performer over the last week, even though everything was red. That's a good sign. I mean, anytime that the market goes down and we start seeing rotation into more aggressive areas of the market, that's a good sign. And same thing happened in the sectors, which we'll talk about in just a minute. But the Nasdaq down a little bit more than 2%, S&P 500 down about 3.75%, the Dow just a little bit more than that, S&P mid cap down 6%, Russell 2000 almost 6.5%, and transportation stocks fell more than 7%. So still got an issue with the small caps, transportation stocks, those areas continue to lag. Moving on to the sectors, technology, communication services, and discretionary stocks, the three aggressive areas during a down week. Net, it was a down week, but these three aggressive areas, top of the leaderboard. So this is something that we can kind of take away that perhaps we've established the bottom. I'm not going to say we're not going to go back down and revisit it. And depending on, what that looks like on the way back down, that'll help us determine whether or not we hold, if in fact we do get that double bottom. But yeah, these three leading during a week of turmoil and during a week of net losses, that's a good sign for the market. So I am happy to see that. Other areas of the market, you see energy down 12.5%, materials down 7%. Then you've got real estate, financials, industrials. These are more value-oriented areas. Financials and industrials, I still consider to be aggressive, but they're less aggressive or they're maybe aggressive value, if that makes any sense. Um, but anyway, they're all down toward the bottom half of the sector leaderboard. So rotation is actually favoring the bulls, at least what we saw. Now, that doesn't mean we're just going to go right back to all-time highs, but I think it does start to paint a little bit more bullish picture if the market starts to go back down again. And that's certainly a possibility. Let's take a look at the S&P 500 here, and I'll show you what I'm talking about. We were previously heading into April. We were previously in a range of 55.21. That was the lowest close that we saw in the S&P 500 coming out of this decline from February 19th high down to the March 13th low or March 13th close. That we went from 61.47, which was the high, down to a close of 55.21, and we bounced. Now, I didn't highlight it on here, but this gap support from back at the in the from the November presidential election, this was 57.82. This open on January 13th was 57.82. So key support, I think we can assume, was 57.82. But once we dropped below that level and finished down below that level, that then set resistance at 57.82 and support once we found a bottom at 55.21. That was the trading range as we went throughout the second half of March. Notice when we bounced off of the low at 55.21, we got back up to, I think, 57.86 intraday. We did not close above 57.82, which was that resistance level. So we went up, we tested it beautifully, and then we fell apart. Came back down, tried to hold on 55.21, one more test of the 20-day moving average, and then down we went. And we went down hard. So we were at almost 5,700 on April, what was this? April 2nd at the close? Yeah, April 2nd at the close. That was a Wednesday. That was right before President Trump came out with the tariffs. Remember after the close that day. From that point forward, in 3 days, we went from 5,700, 56 and almost probably 56.80, something like that, down to a low of 48.30, which was very close to the breakout that we saw from when we broke out above the 2002 high. Remember at the beginning of the year, we were up at 48. I think on January 4th, 2022, I think we were at like 48.19. That was the key level where we broke out from a long-term perspective. And we went back down and essentially on Monday tested that level almost from roughly 40 or 5,700 down to 48.30 or 48.40, whatever the low was. So we're talking about 800 and some points. Now, today feels great. Don't get me wrong. We were up 474 points. Second best day in the history of the NASDAQ, by the way. One of the best days in the S&P 500 going back years and years and years. So this wasn't anything to, ignore. I mean, this was a big day. But big days tend to come after big losses. I mean, you got to keep these things in perspective. Where were we a week ago? Right where we are now. Last Wednesday at the close, we were at 56.80 or thereabouts. We're sitting at 54.56. Ordinarily, what other week would we be so excited after losing 200 points or 4% on the S&P 500? But all we're thinking about right now is today and the big rally. You got to keep all this stuff in perspective. This rally fell short of the 20-day moving average. It fell short of 55.21. Now, I don't know where we're going tomorrow. Let's see what happens tomorrow. But I'm just saying, yes, it was great to have this rally. It feels good, but don't let your guard down. Just say that. Do not let your guard down. So today we had our live trading room. And literally, our members can confirm this. But during the middle of our trading room, it started at 10 o'clock and it was a little bit past 11. This went on for almost 2 hours today. But just a little bit past 11, we had come down and we had tested. You see where the IWM is testing the low from Monday? And so what I said at that point was, this would be a good opportunity to get into either the IWM, or if you really wanted to be risky, get into the TNA, which is a leveraged ETF that tracks the IWM at 3 times. So if the IWM in theory goes up 1%, the TNA should go up 3%. Again, in theory. Anyhow, notice we held on to this low. We did go down one more time because I bought at 11.18 this morning. And I bought the IWM at 173.51. Pointed it out to members as I was buying it. Look at what happened. Now, sometimes it's better to be lucky than good, because about an hour later was when Trump came out with the announcement that the tariffs would be paused. And look at what happened after that. So I can tell you, for me, I'm back out. I don't know what's going to happen tomorrow morning, and I'm not putting my money on the line, at least not my trading account money. In my retirement and some of my other accounts, what I've been telling members is to use the weakness that we've seen over the last week, these gap downs in the morning, to buy. I bought some early on Friday and again early on Monday during those big gap downs to establish positions for the longer term. And I've still got more to come if the S&P were to go lower. Now that we've had this kind of a rally and the tariffs have been kicked down the road, maybe if the inflation comes in a little better than expected, or even as expected, not worse than expected, and we were to pull back again, getting down close to the recent lows, it might happen next week. It might happen tomorrow. It might happen in a month and a half. I don't know. But I'm just saying, if we were to go back down near those lows, that would be the time to think about long term, in my opinion anyway, getting into the market. Because I don't think, and I think this demonstrates it again, market's been manipulated. We've been looking for something, clues from a sentiment perspective. I want to show you. Here's a chart of the volatility index. And I want to just show you at every spike over the course of the last year, every time we've had a spike above 20, 25, I want you to check out. Here's the green dotted vertical line showing you where the spike occurred. And I want you to look at where the S&P 500 was at the time of that spike, at the peak. And you'll see that they line up with almost every significant bottom in the S&P 500. We just went to 60, folks. Where did we get down to? 5,000. Should we be surprised that we had a big rally? No. This is what happens when sentiment gets stretched so far. To me, it's like the S&P 500 is going down, but it's like being stretched like a rubber band. And when it snaps back, it comes back hard. It snapped back today. So the VIX is one clue. Another sentiment indicator that I like to follow when the market's in free fall is the equity only put call ratio. This is a 5-day moving average that's showing up here. And I want you to look at when we get up to this 0.75 area. Here we did it back in April, right near the low. How about in early August? Right near the low. How about early September? Right near the low. What did we just do? We just hit above 0.75 right before we had this huge snapback rally. I say, whenever the market gets volatile, when it gets panicked, it's hard to pick bottoms based on prior support levels, because you get just this indiscriminate, impulsive selling that takes place. And a lot of times you just go right through support levels like they're not even there. The way you mark bottoms in a volatile, scary, bearish type market is you've got to have capitulation in sentiment. That's the way you get there. QQQ, if you recall, if you followed me for these last several years, back in June of 2022, I said I'm calling the bottom in the market. One of the reasons I called the bottom in the market, there were a number of reasons, but one of them was I believed the market was being manipulated lower. We started moving down, but we did it, well, we continued moving down, but we started doing it with gap downs as opposed to intraday selling. It was just gap downs and maybe a little bit of morning selling. And then we would see rallies later in the day, and we'd see what appeared to be accumulation. Who in their right mind in June, when we're breaking down in a bear market, who would buy besides market makers for their institutional clients? I wouldn't. You wouldn't. Everybody's scared. You're not trying to find the bottom. You're If anything, you're panicking out of your positions. So you got to pay attention to what's going on in the market with market makers because their job is basically to serve those big institutional clients to get them the best price possible when they put orders in. Well, in a bear market, it's really easy to do because there's a lot of willing sellers, a lot of retail traders can't take it anymore. And they see the gap downs, they react to the gap downs, they sell. This is how market makers accumulate lots of shares for their institutional clients. And as this continues to go on, they can accumulate millions and millions and millions of shares from unsuspecting retail traders that think we're going to zero in the market. We're not going to zero. Anyhow, first thing, look at the QQQ. The price was at 540, went all the way down to 405, setting a 52-week low on the QQQ. And look at the AD line, the accumulation distribution line. We went down some. Look at that quick snapback. We're much closer to the high than we are the low. And that's the way we were even before today. So this was really, really solid action on the QQQs and across the market. But I wanted to show you another chart just to show you the manipulation. Here's Palantir. Palantir was 125, and it went all the way down to 66, something like that, 66 and change, almost in half. Look at the AD line continuing to go up. And one of the things that we do for our members is we'll research and we'll do a lot of Excel spreadsheets. And then our annual members, those who stick with us for a while and are committed to our service, we commit to them, give them some of the best research data that's out available in the market. I want to show you what we just gave them a week ago. I'm going to pull up an Excel spreadsheet, and I'm going to go first over to the QQQ. And essentially what this spreadsheet does, I don't want to spend a lot of time on it, but every day we have the price of the QQQ at each one of these time periods, at the opening bell, at 10 a.m., 11 a.m., 2 p.m., and the close. And that's all Eastern Standard Times while the market's open. And then we take the change for each one of these time periods and mark them down there. And then we come down to the bottom and we go through different, periods where we're taking a look at the cumulative summation of what's happened during these various time periods, like for a period of a month, and breaking it down between what happens at the opening bell, what happens between the open and 10 a.m., what happens between 10 and 11, what happens between 11 and 2, what happens between 2 and 4, to get an idea of how we're trading throughout the day. What I can tell you from my prior studies and from experience is that when you first start going down, you have what I could call a distribution phase where you are selling off all day long over all time periods throughout the day. The net of all those time periods within a downtrend will be negative. There'll be selling. When you start to get to a point where you're seeing a lot of gap downs and a little bit of additional selling in the mornings, followed by buying in the afternoons, to me, that's a sign that market makers are starting to accumulate. That was the reason I called the bottom one reason I called the bottom on June 17th, 2022, right before the S&P 500 went up 700 points. And it's also a reason why I've been talking to members recently about we're being manipulated again. The QQQ, since the beginning of the year, has gone down $44. We started the year at 510.47. We closed today, even after rallying $50, we closed today at 466. We're down $44 year to date. Do you know what the opening gaps have been year to date? It's right here, 43.85. Essentially, the entire move this year has been a gap down at the opening bell. The net effect during the trading day is roughly zero. But what's even more shocking is since March 26th, we've seen the overall market go down, or we've seen the QQQ go down $27. But we've lost $53 at the opening bell, and it's net buying throughout the rest of the day. That's what we've seen for the last 2 weeks. Now, you can ignore it if you want, but as far as I'm concerned, it's a sign that we're being manipulated. QQQs, everything's selling off at the opening bell. We see that. and we react mostly selling. That's why in my retirement and some of my other accounts where I'm holding longer term, I've been buying it in the open. Early morning action when the market's down, I've been buying because I'm seeing the manipulation. This is what market makers are doing. They're letting you sell in the early action and then they're buying. And so I'm doing the same thing. But let me show you Palantir. Same setup. Take a look at Palantir. Palantir, since the beginning of the year, is up $16. 75.63 is where we were at the end of 2024. And now we're at 92.01. That's a positive change of $16.38. Do you know year to date? Well, not year to date, but over the last 2 weeks, Palantir's gone down $4. It's gone down $21 at the open. If you net all of the opens over the last 2 weeks, it's gone down 21, which means if you add up all the other periods, we're actually seeing net buying in all the other periods of the day of $17 to net out to a $4 loss. Anyway, I find this to be absolutely incredible, and I just wanted to point that out to you. I want to also point out for those of you who are maybe seeing us for the first time at Earnings Beats, we've got a free newsletter. We've got a paid service that has a 30-day no-cost trial. If you go over to earningsbeats.com, we'd love to have you. Again, try us out for 30 days. You'll have to give a credit card with our paid service, but there'll be no charge. And before the 30 days is up, we'll reach out to you to make sure that you want to continue. If you don't like the service or you don't find value in it, no skin off our back. That's fine. We're not for everybody. But I think we've done a really good job with our market guidance over the years. I think our members really love that about our service. And in this kind of volatile environment, hopefully having somebody that you trust, taking a look at, providing market guidance throughout this, hopefully is a value, significant value to you. But anyway, check that out. If you just want to try us for free, not our paid service, but we have a free newsletter. No credit card required. Go down, scroll down at our homepage and name, email address, and subscribe for our Earnings Beats Digest. It's a twice a week newsletter, and it's really not even a newsletter. It's a chart in 2 paragraphs on Monday and Wednesday. It'll take you all of about a minute or two to take a look. Could be a trading candidate, could just be education, how the market works, but make sure you check all that out. All right, last thing I want to do is I want to go over some of these charts that I include in a weekly market recap that I send out to our members every Monday morning. Once a week, I update these. The first one here is the equity only put call ratio, which you can see has been spiking. And again, just marking any previous peaks and where we have seen and what's happened to the S&P 500 after them. You can see that normally we get these bounces after we get a lot of fear coming into the options world, a lot more puts being bought or traded relative to calls. That's a sign that the market is getting extremely, maybe even violently oversold to the downside, and we should expect a snapback rally. This just went out, this past week, beginning of the week, and we said things are building. We're starting to see more and more fear building in the market, and that's necessary to try to print a bottom. And of course, today you saw what happened. We printed a bottom and we rallied strongly. Next chart here. What I do is I ignore gaps. To me, gaps are nothing more than manipulation by market makers. They take the latest news and they decide where they're going to open prices in the morning. And when you're in a downtrend and you keep seeing these gap downs, it wears on you. If you don't know anything better, you don't understand the stock market, and you see this happening for a long period of time where your account is literally going down by the thousands and thousands, maybe the tens of thousands, depending on how big your account is. And you can't take it anymore. You're like, I can't continue to lose like this. I'm selling everything, I'm getting out. That's usually when we're marking a bottom. That's usually the capitulation. And a lot of people reach it simultaneously. And so what I like to do is I look at my ratios, my intermarket ratios, but I keep user defined indexes at Stockcharts, which is a really cool feature. And I come up with my own data. I look at the intraday action on the QQQ, compare it to the spider, which is a little bit more value oriented. And when this QQQ spider intraday ratio is going up and we ignore gaps, That's normally bullish. Look at what's happened in the month of April. Now, remember, the last week we've been going down in the market, but right here you can see the intraday ratio going up. I think that was an important signal based on the rally that we had today. Now, again, we didn't know the news was coming out, but what I did say during the trading room this morning was expect good news to set the market on fire because we're at that stage of violently overbought, increasing fear and panicked actions in the market that we were set up for a rally on some kind of good news. It just so happened we got it an hour later. Next chart I wanted to show you, XLY, XLP. Look at this intraday ratio, which had completely fallen apart, taking out some recent support levels. And look at this coming right back up, making a huge move back to the upside. Here's what, if we include gaps, if we just take the XLY versus the XLP, you can see that it's actually been moving lower. But if we strip out the gaps, that manipulation, and just look at what's actually happening during the day, look at it. QQQ, or excuse me, XLY, discretionary relative to staples, making a huge run to the upside. Last thing I'll say is that small caps, which I think should do very well when rates are coming down. Well, we kind of took a turn for the worse here over the last few days. And you can see small caps relative to the QQQ or the Mag 7 turning back down in a pretty big way these last few days. So we're going to have to wait longer on the IWM. I still believe it's coming. I think we're going to have a massive rally in the IWM at some point. But I think we need to see the Fed get back to lowering rates or talking about lowering rates before we're going to see a lot of rotation back into the IWM. That's my opinion, at least right now. So anyway, that's basically what I had for you today. I really appreciate you tuning in. Thank you so much. But I am back ready to watch the market for you. And I'm just going to tell you like it is what I'm seeing. I do think we're improving here. I don't think we're out of the woods. I'll see you next week. Happy trading.